Welcome to this explainer. If you've ever looked at a price chart and felt like you were just staring at the matrix, well, you're in the right place. We are going to decode that visual data together, step by step. Let's kick things off with a pretty harsh reality. 90% of traders fail. They lose their money and they just walk away. Why? Because they treat the market like a giant casino rather than taking the time to learn its actual language. If you don't have the focus to study the mechanics of price, you simply don't stand a chance when real money is on the line. So, what's the secret? It all boils down to this core thesis. Trading is actually a lot like a game of poker. You're calculating odds, you're looking at the hand you're dealt, and you're managing your risk. It is absolutely not a crystal ball for fortune telling. Nobody knows with 100% certainty what the market will do next. Our goal is simply to increase the odds of being right. Here's our roadmap for today. We're going to look at the reality of trading, break down candlestick anatomy, learn how to read the market's mood, decode some specific patterns, and wrap up with a professional trader's framework. All right, let's jump straight into the reality of trading and how to go from a gambler to a risk manager. Look, if you want to succeed here, you've got to completely let go of the need for 100% certainty. A novice trader demands to be right every single time, gets super emotional when they lose, and essentially just gambles. But a professional, knows that one single trade means absolutely nothing. It's the structured process that means everything. A pro treats losses simply as business expenses, just a natural part of the game. So you have to ask yourself, which mindset are you bringing to the table? Okay, moving on to the anatomy of a candlestick. Think of this as the alphabet of the markets. Right, so behind every single candlestick is a literal battle between buyers and sellers. At its most basic level, a green candle means the buyers, the bulls, won that specific time period. The price went up. A red candle, that means the sellers, or bears, took control and the price went down. And you know what? It doesn't matter if that candle represents 1 minute, 1 hour, or an entire day. The logic is exactly identical. Now, every single candlestick gives us 4 absolutely critical data points: the open, the high, the low, and the close. We usually just call this OHLC. That wide, solid part of the candle is what we call the real body, and it shows us the actual distance between the open and the close. It perfectly summarizes the exact territory won or lost by the bulls or the bears for that session. But notice those thin lines sticking out of the top and bottom? Those are the wicks or shadows. And man, they tell a really vivid story. They show us where one side pushed the price to an absolute extreme before the opposing side fiercely fought back. If you see a really long wick at the bottom of a candle, it means sellers pushed the price way down, but buyers stepped in with massive strength to reverse it right before the period closed. So, let's shift gears a bit and start reading the actual market's mood. We're looking for momentum and indecision. When you spot a candlestick body that is just massive compared to the 3 or 4 right before it, that right there is a momentum candle. It indicates this overwhelming surge in strength and speed from either the bulls or the bears. It's the market telling us that one side has aggressively seized control. On the flip side, we have the doji, which screams extreme uncertainty. The real body is practically just a thin line because the open and close prices were almost exactly identical. It's like this massive tug of war where nobody actually won. If you're riding a strong trend and suddenly a doji appears, pay attention. It acts as a major warning sign that the current momentum might be stalling out, and the market sentiment could be shifting. All right, let's decode some candlestick patterns. This is where we start taking that alphabet and forming words and phrases. To keep things simple, every single pattern out there, and there are dozens of them, can be categorized. First, by complexity. Is it just one simple candle or a complex group of 2 or more? Next, direction. Are we looking at a bullish, bearish, or neutral signal? And finally, type. Is it meant to reverse the current trend or continue it? Context is absolutely everything here, because the exact same pattern can mean entirely different things depending on where it shows up. Let's look at some reversals. Take the hammer. If you see this after a long downtrend, it shows sellers tried to push the price lower, but buyers aggressively rejected it. That lower wick is usually at least twice the size of the body. That's a classic bullish reversal. Then you have the engulfing pattern, which happens when a second candle's body completely swallows the previous one, showing a total shift in dominance. And a shooting star? That's basically the bearish version of a hammer, a long upper wick showing buyers got completely exhausted and sellers took over. Next up, continuation patterns, like bull or bear flags. Imagine a massive, strong momentum candle shooting the price up. What usually follows is a series of small, low momentum pullback candles just drifting sideways or slightly down. What does that mean? It shows us a market that isn't reversing. It's literally just catching its breath before violently resuming its main trend. Which brings us to the final piece of the puzzle, the trader's framework, the grammar of execution. Listen, without a non-negotiable three-step framework, you aren't trading, you're just guessing. First, you have to find a clear pattern, your market setup. Second, you plan your exact numbers before you ever even think about clicking buy. And third, you execute without emotion and review your actions afterward. The absolute most crucial point here is that a setup is completely useless unless you define three specific things. Exactly where to enter, often right when a pattern confirming candle closes, exactly where you're going to take profits, that's your target, and most importantly, exactly where you will admit you are wrong, your stop loss. If any of those three pillars are missing, you are gambling, plain and simple. Let's talk a bit more about that stop loss. A super common professional strategy is to place it just outside the pattern's extreme point. Say you buy based on a bullish hammer. Your stop loss goes just slightly below the lowest tip of that hammer's wick. We leave a little wiggle room so normal market noise doesn't trigger it, but by placing it there, you ensure that one bad trade will never wipe out your account. The pattern is invalidated, so you get out. And this all leads directly to the math of profitability. By setting targets that are twice or three times as large as your stop-loss risk, the math shifts entirely in your favor. Think about it. If you risk $1 to make $2, you can actually lose more than half your trades and still come out ahead. Successful trading isn't about always being right. It's about keeping your losers incredibly small and making your winners much, much larger. So we've decoded the language of price action, from the intense battle inside a single wick all the way to complex continuation patterns. We've even laid out a strict risk management framework. But now, the ultimate question is entirely psychological. Are you ready to abandon the need for 100% certainty? Do you actually have the unshakable discipline to execute your plan and just step away when there's no clear setup? Because honestly, that discipline is exactly what separates the 90% who fail from the top 10% who truly